Good morning. Today is Thursday, March 31st, 2022, the last day of the quarter. And what a quarter it's been. I remember doing the macro presentation in January, talking about where we could go and maybe 3 or 4 rate hikes this year. We weren't really talking about Russia with any credulity. And then, of course, everything's happened. So it just goes to show how unpredictable markets can be at times. But really, we think back 3 months ago, and many of the same things that we were talking about then are actually still in place today. Obviously, things change their color, but you can change color and still have the same lines, and you're painting in the same lines. So I think that's similar to a similar analogy to how we are based today. Big story today is obviously the end of the quarter and all the ramifications that'll have in terms of rebalancing. I do think a lot of rebalancing has already taken place, and we'll talk to Tom a little bit about that later today in this call, especially as it relates to the bond side. But we're going to start off on oil. The oil price wars are actually very interesting to watch right now. You have India, which is really just trying to make the best deal for its people. They don't want to run a heavy current account deficit, and they do have to import a lot of oil in order to fund their economy, to run their economy. And so what is happening is Russia is actually offering India oil at discounts of as much as $35 a barrel compared to the pre-war price. So not what it is today, but to the pre-war price. It's actually a $45 discount to where Brent oil is trading right now. So you're talking about $65 a barrel versus $110 per barrel of Brent on the spot market. The biggest problem with this is that India's refineries aren't configured to buy a lot of the Russian type of crude. You have to reconfigure those refineries, and so there'll be a cost associated with that. So Russia's offering a discount with that. Connected with this, India also wants to export more medicine, engineering goods, and chemicals to Russia in order to make sure that budget is remaining balanced. So India somehow is actually operating with what appears to be a significant amount of leverage and extraordinarily transactional in its behavior right now. The U.S., meanwhile, is considering a massive SPR release. We've talked about the previous SPR releases from the Strategic Petroleum Reserve. That's been on the order of 30 to 50 million barrels. This one could be up to 180 million barrels. It would be designed to release 1 million barrels of oil per day for the next 6 months. Be the largest ever release from the Strategic Petroleum Reserve. It would amount to about roughly a 1% addition to overall oil supply globally, and about a 10% addition to daily U.S. production. As of March 25th, the reserve had 568 million barrels remaining. So this would use about a third of that. It comes ahead of the OPEC Plus meeting, which is actually going on right now. OPEC Plus is signaling no change to their procedure. They're kind of held hostage to Russia right now. Russia and Saudi Arabia are the leaders there. And so the U.S. is really trying to coordinate a release of oil with some of its allies in kind of an anti-OPEC way to depress the price of oil relative to where it's trading right now. The problem with the U.S. response is that we're putting kind of a mask on versus what the true underlying issues are. And so what we're actually doing is, by depressing the price, we're removing an incentive to produce more oil. So while in the near term, we may be able to get a lower oil price, come October, when that Strategic Petroleum Reserve output comes off the market, you could actually have higher oil prices. Now, this will probably be tempered a little bit because of normal seasonal patterns in demand. You have very busy summer travel season shaping up. That'll mean more oil demand, but that should taper off into the fall. So maybe that'll offset a little bit as this SPR release fades away. But the big picture is, we're trying to put a Band-Aid on a problem that's more of a disease, and we need to incentivize production if we want longer term sustained reductions in the price of oil.
Yeah, I find it interesting. I mean, I'm a little bit conflicted on the size and the scale. I mean, we talked about the previous releases of these reserves, and it just was kind of a drop in the bucket, didn't accomplish a lot. I think you're spot on in terms of the ramifications. You know, this is not necessarily going to encourage actual production. And so I think that's a problem. On the other side, I mean, I will say, and I don't necessarily mean this to imply that I agree with current policy as it relates to, you know, petroleum, any fossil fuel at large, but it is at least consistent. You know, we have one of the things I've always wondered, we have this massive strategic stockpile of reserves, and yet the administration has been very clear on they want to get away from oil dependence. And that kind of raises the question, well, what's the point of these reserves? So if you have them, you know, might as well use them. So when we think about the massive amount of the reserve that would be depleted over this, in a weird way, it's at least consistent with the messaging and their priorities, which again, I don't say that's right or realistic as an expectation, but it does make sense. And I think if you combine kind of the summer travel schedules, as well as I think everyone's hope that this Russian conflict will hopefully have subsided or cooled or have more certainty by the fall, maybe the timing is okay. Tom, I don't know if you have any thoughts on it. Again, I don't imply that that's a ringing endorsement of it. The whole thing is funny money. That's part of what makes investing in the energy sector so difficult. People can react and overreact very quickly, and it can have massive impacts. But Tom, any thoughts?
I mean, really, it's really like 2008, 2009, which is, I think that ultimately the price is going up as a result, in my mind, to the fact that it's not even really a supply issue as much as everybody knows that there is a supply issue. It's like, if you know there's a supply issue, if you're a trader, if you're somebody who's in possession of oil contracts, why would you not raise the price? And then everybody else is going to raise the price, and it kind of becomes a self-fulfilling prophecy. And the more you try and push the price of oil down, I mean, if you think about just traditional economic supply and demand, the higher the price goes, the less demand there's going to be. If you artificially try and do things to push the price down, then demand is going to stay high, which is going to push the price up. And so it just kind of becomes this, you know, cyclical, like reaffirming situation, which I think is what happened in 2008, 2009. There was both speculation as well as high demand and low supply. And I think we're coming back there now. But I think the strategic reserve is there for that reason, right? It's strategic reserve. We have it in case something wild happens, and we're in the middle of something that wild happening. So I think we should let loose with what we've got, and then, you know, try to reassess at a later date.
Yeah, I agree. It's not too dissimilar from the toilet paper craze of the COVID days in 2020. You know, there was concern about supply, which created demand. And ultimately, I don't personally know anyone that used the restroom and didn't have toilet paper on hand. So, you know, if that's you, please let us know. Maybe we can have you on the show and you can come in and tell your story. But I agree. I mean, I think, I don't know, I want to be, I guess, consistent. If we criticize the tiny, minuscule oil reserve release of a couple weeks ago, we should at least recognize that they're doing more. Again, doesn't mean it's right. Ben, Apple is developing its own payment processing technology, building out the infrastructure, is calling this Project Breakout. How does this play out? I mean, it seems like it could potentially be relatively disruptive.
Yeah, this is quite interesting. I know we talked a little bit about Apple pursuing various ventures in the past. I think that as we look about this from an investing standpoint, I think what our standpoint is, Apple has a machine, they have a very strong business, and we have ownership in Apple, which is a good thing. We always have to be, however, cognizant of the businesses that such a company could disrupt because of the ecosystem advantage and because of the balance sheet advantage. And so as it relates to this Apple story, that's kind of the context of which we're viewing this. So first of all, this Project Breakout is basically a multi-year plan that would bring a range of financial tasks in-house. So this includes payment processing, it includes risk assessment for lending, it includes fraud analysis, credit checks, dispute handling, and it really is focused on future products versus current products. So current products like the Apple Pay monthly installments, that'll be run with Goldman Sachs still. But future products, the one that's most likely to come soon is this Apple buy now, pay later. This would allow consumers to purchase things with Apple Pay in 4 installments with no interest. And I think that would be an interesting thing, especially as it disrupts some of these other vendors who are really pushing heavily into this buy now, pay later space. Their current vendors that could be disrupted, their core processor of transactions right now is CoreCard, but if they bring that in-house, CoreCard could really be hit big time. CoreCard was down about 10% yesterday, and we are monitoring it because it could be a threat to companies like American Express. So that's the lens through which we're viewing this. It's still very much in the high-level phases. I mean, we've heard about an Apple Car for years now, and we've never actually seen an Apple Car. And we've never really been that close to actually having the product on the road. But, you know, we need to continue to monitor this. My expectation is that this would be a fairly slow rollout. It wouldn't be an overnight thing. And it would take some time to get up to scale. But it's really interesting, Apple pursuing a financial services business, particularly because the margins on financial products like this are not strong. But with a balance sheet like Apple's, it could be accretive to their earnings.
Yeah, I think the companies I would be most concerned for would be kind of the smaller, more specialized players. Thinking specifically of a company like Affirm, which is big on the installment payments. You've probably seen, whether you recognize it or not, if you've made any purchase of practically any amount. It used to seem like if you made an online purchase of a sizable amount, they'd offer to, finance it out for you or give you interest-free payments for a year or what have you. I see that logo on everything. You can be buying something for $10 and they say, hey, do you want to make this in 4 payments of $2.50? So I think Affirm, companies like that could very much be in the crosshairs. I would like to think some of the larger players, thinking of companies like American Express, would have such a lead in the existing infrastructure they have that they'd be able to evolve. But the appeal that Apple would offer over something like Affirm is just that frictionless experiment. You have an iPhone, it's got all your information in there. Obviously, your credit card's linked to any payments that you've ever made with that phone. It could be something that just presents an easier way to split up payments than having another third-party app. So something to keep an eye on. Tomorrow, big day. Got the jobs report coming out. I think we were talking about this a little bit before the call. I think there's pretty varied potential returns as it relates to both equity markets, specifically because of what would happen in the fixed income rate space and expectation for rate hikes. Ben, I want to start with you and kind of get your high level expectation, things to watch for on the report itself, and then I'll throw it to Tom for how those scenarios could impact rates.
Yeah, the estimate right now is for 490,000 new jobs in the month of March. That's down from 678,000 in February. I wouldn't be surprised to see some pretty big revisions, and they could go either way. What's happened most recently is those revisions have been up. And so I'm curious to see what happens. Sometimes weather plays a role in terms of the non-farm payroll report in the month of March. You obviously have the issue of the Russia-Ukraine situation. I am reasonably positive that we could get an upside surprise here, given the fact that there are so many job openings as reported in the JOLTS job openings report from the month of February. The other piece is the ADP employment report that was reported on Wednesday was actually fairly robust, and the non-farm payrolls has been outperforming that. So that'll be a significant thing to watch. And then finally, on the unemployment rate, I wouldn't be surprised to see at the unemployment rate, it's supposed to go down to 3.7% from 3.8%. But I wouldn't be surprised to see the participation rate actually increase a little bit. We're starting to see people come back to work based on some surveys that we've been seeing, and that could have an impact on the participation rate, which could allow for some slackening in the labor force and some opportunity for that unemployment rate not to be continuing to go to zero. So that would be my view on things. And I would generally say that this would be a vote of confidence for the American economy, despite what we've seen in Russia and Ukraine over the last month. So that would be my base case. Obviously, I don't have the report in front of me yet, so I'm ready to be wrong on it.
So Tom, if we get pretty robust data, upside surprise, or at least something pretty stable? What do you think what's the read through going to be on the rate situation?
I think in an upside surprise, then that's probably going to be very negative for bonds. I think it's going to show that, hey, the Fed raised rates and the jobs market stayed strong, which means they've got more wiggle room to raise rates additionally. On the other side of it's very, very bad. I think that there's also the possibility that could be spun the exact same way, which is to say, hey, the Fed raised rates, it had an impact. That impact could be telegraphed as it slowed the jobs market, which is something that they said they were willing to do in order to raise rates. But again, it all really comes down to how does the market digest this? What is the main takeaway? Because after, call it 45 minutes after the report comes out, there's going to be a narrative, and that narrative is going to drive the trading. And so if the narrative is this jobs report was really bad because the Fed raised rates, then the possibility could be either they're slowing or they're accelerating based on how that's interpreted. It also could be discounted, like Ben said. There's a lot of weather that's always related to what happened in the first quarter. That was a Janet Yellen go-to when she was the Fed chief. She'd always be like, oh, well, it snowed and that really hurt the jobs market in February. And so that's something to be cognizant of as well, because if it's bad, they could just write it off and say, hey, this is just weather related or some exogenous shock related. And then the upside, I think, is just going to be straight negative. I think it's going to be, this is a really strong economy. We can raise rates to the moon and it's not going to slow us down. I think the best case scenario in terms of really being able to not have a lot of volatility would be for the numbers just to come in right in line, which would be my hope. But my expectation, I think, is to an upside surprise as well, as Ben said.
All right, we'll see what happens. We'll be back tomorrow morning at 8:30. Hope you guys have a great Thursday, and we'll talk to you soon.